Hey everyone, it's Ed Kime from Quantcha, and welcome to another day of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and option trading offer over at Quantcha.com, where for $99 a month you get everything we offer on our web tools, as well as unlimited commission-free stock and option trading. And that's what we're going to be using here today in our platform. So let's go ahead and dig in. We'll start off on the agenda. We're going to take a look at a quick portfolio review to see where we are today. The first thing you might notice is, if you've been following along, is that we used to have a carnival position that's now gone. That basically caught its offer earlier today. We had a standing good till canceled order that was sitting out there. We were trying to make half the profit. The market had a nice little rise this morning. It's actually been rising all day, so it's been a pretty good day for the bulls. And it caught for us, so we were able to close that position out and pull in about half the profit, or exactly half the profit that was available for that. And the good news is that trade was well ahead of schedule for the money, so we only held that for about 10 days. And I feel pretty confident in Carnival still. I think there's still a bullish story, so we may look at opening up another position like that. So I think we made close to 45% on that particular trade, which I was pretty happy about. Nothing else filled at this point. We have a couple other standing orders. They didn't. There's four positions that we have on the books today. I'll start off talking about Exxon. This is a bearish spread we have that's still got a couple weeks left on it. It is definitely worked against us today as the market has lifted all ships. You'll notice that it continues to not really move up as much as the market does, and on down days it seems to go down a little bit more. We're not going to touch Exxon today. We're going to leave that there, let it continue to be bearish. We also have three other positions that we're probably going to get into today. The first one is our Johnson & Johnson straddle. Now we opened this up earlier in the week. The whole idea was we wanted to hold it and then exit the day before earnings. And the goal there was to say we want to hold this straddle. Ideally, we bought it in a relatively low volatility, which is around 24%. If we head over now, we can see that the current vol for this expiration is over 27%. So what we've done is we've managed to make a gain off of two things. One here, and I know it's a relatively slight gain, but what we've done is we've gained on some movement. The delta, it was a little over 128. Now it's almost 131. So we've got a nice upward movement in our call, and we lost some value in the put. But in addition to that, because we are, in this case, long Vega, which means we have money to gain by volatility increasing on both these options, we were able to make a good amount of money. In this case, we started with a relatively small amount and we did a fairly low risk trade. So being able to get anything out of that's nice. Now I'm going to go ahead and start working through this because we need to close this today. So I'm going to go to close book to just put an order out there. The net credit right now is 495 if we were to get it at midpoint. Let's just have it sit there at 5 to see if we can get that. Oh, actually, my mistake. We have a standing order for this, so we're going to have to use that one or cancel it first. We'll just go ahead and use it. We were trying to see if we could somehow get 550 if there was a big move or somebody willing to be a big spender. I'm going to just move this down to $5, change the order, and we'll let it sit there. I don't know how quickly it'll fill or if it'll fill at 5, but we'll just continue to move on and we'll let that sit there for the time being in the hopes that it might fill. So this has been a pretty good trade. I'm pretty sure we'll close this for a profit. Right now the market pricing shows that we're already up, so we should hopefully eke out a little bit more. Even if we just gained, let's say, $24 on this trade, that's a 5% return on this in the week. And it was a relatively low risk trade, so it's obviously we'd love to make a ton of money, but not bad. You got to take what you can get. If we get a lot of wins, then that'll add up over time. Microsoft is an interesting trade because this has continued to move up for us. Now today, Microsoft was up a little higher earlier. Let's go to the daily chart. It was up a little higher, and then it's sort of been trending down a little bit. I still feel really bullish about the company. I kind of have a standing bullish position. I love Microsoft. I think they're a great investment, especially where they are now. And so this covered call we have, the one thing I said is I don't want to hold it through earnings. So we have one more week of trading it, and then we're going to get out of the way when earnings happen, and then I think we're going to get back in once the dust settles. And of course, we're putting some of the gains at risk, or we're putting potential gain at risk, but we're going to try to make up for that through smart option plays between earnings announcements. So where we stand right now is we had rolled. In fact, we'll go to our performance just to take a look at how this trade was. So this is our current position, right? We started off, we had a covered call where we bought 100 shares, sold this 105. Then we rolled on the 16th, which was 2 days ago. We rolled out of the 105s into the 106s for the week after. We collected a little bit of credit. And the idea was we wanted to collect some credit on the roll, and we also wanted to give the stock more room to move up. And at this point, as you can see, the stock's moved up pretty hard. Or maybe not hard, but it's moved up nicely. It's definitely appreciated in value. But the downside is, one for one, every penny it moves up over 107 or over 106, we're gonna have to give away to this short call as we get to expiration. But the good news about covered calls is that in the movement, the delta of these options that are very close to the money is much lower than the one delta we get per share, which means that we still have the opportunity now. We can actually roll up on this call, and we'll have to take a little bit of a loss on this specific call by rolling it up to, let's say, 107. But by rolling it up to 107, we now get that $100 per share that the delta represents between the 106 call strike and the 107 call strike. And I'll show you what I mean. We're going to head back over to the portfolio, and we'll put in something to manage the book. Now, the when we go to manage our book here, what we're looking at is the current P&L for our current holdings, which is this 106 for next Friday. Now, if we take this opportunity to come down here, click the roll button, and look at that same next Friday, and we're going to find the 107 calls, and so many here. Now this 107 call, what'll happen is if we roll to that, the main thing you'll notice is if we come to track changes, we can see it'll cost us $65 to do that. That's because we're basically buying back a call that we hold, and we're selling off a new call that's a little higher up on the strike. This means that we have more room for the stock to appreciate, but it also means that we're going to expect less premium for that call. Pretty straightforward option stuff. Now the P&L we get here, the profit and loss layout, this blue is still the same as what we were looking at before, but the new yellow line shows what would happen if we applied our pending book and we made that change. And the main thing to note is we would be looking at a slightly increased amount of return. So we've got $89 in time value remaining on the current short call, and we would have if we made the change, we'd be looking at an impact of $124. Now, what that's basically saying is it's $100 are going to come from the stock, and 24 of those dollars are going to come from the time value on that other option, or rather the difference in the time value. So where the net change in the value here is actually $35 for the expected P&L, because the 124 minus 89. So in the event we stay up here above the strike and it gets called away, we'd have a little bit more money to be gained. So in this case, $35. Now the question is that going to be worth it? And right now I'm going to say it's not going to be worth it for us because for two reasons. One is that we do want the stock called away. We're fine having that happen. We want to get out of the stock before earnings, and I have no problem just letting it get assigned later on. But perhaps a little bit more importantly is that it's this downside protection. You can see that as we currently hold, as it starts to move below this point here, we break even around 105.73 in the event that we make this change. But we get to go all the way down to 105.09. So that might not seem like a big deal, but that's 65 cents or so. It's a huge difference in terms of the probabilities here, because here we're looking at there's about a 25% chance it should go below, or maybe 27% chance it'll go below our current book. But as we get up here, there's a much higher probability. This is about 35%. So it's really just it's an exercise in balancing, and there's really nothing wrong with making this trade. If you're someone who wants to be a little more aggressive and you're more bullish on the stock, and you want to capitalize on the upside movement, then that's fine. And if we knew for sure, if we were guaranteed that this stock was going to continue to go up, I'd make the roll, or even roll higher, because you want to kind of capitalize on the best opportunity. At the same time, if we had concern about the stock dropping between now and then, what we would want to do is we might roll down. And what rolling down would do is it would cut off a lot of our upside potential in the stock, but we would gain more value from the sale of the option itself. That being said, most of that value would be intrinsic value. So if we rolled it down, we'd be collecting money that was effectively like selling the stock at that price already, or rather selling the stock at the current price and locking in a bit more of the gain. So I wanted to call that out. We're not gonna make this change just yet. We will. I'm gonna sit on it and we'll think about it a little bit. Maybe what we'll do is we'll consider if we continue to see upward movement in the stock, what we would do is we would end up getting less value for this trade if we held off. And if the option were to move down, we'd end up getting a little bit more value for the trade itself. My main concern is the whipsaw effect, which is that the stock. This is a very common thing that happens. People trade secured puts, covered calls, or anything like the wheel, where you're going to rotate through these strategies and combine them. Which is, you get into the stock at a certain point. Let's say you get into the stock, we'll say here. You do it at the money call. You sell it there, so the stock goes up here. It gets called away. You make a little bit of profit, and then you enter a position here. Let's say you sell the put here, and then it drops. And now, even though you were profitable on this first part of the trade, you ended up losing more on the second part of the trade, even though the stock ends up really at the same position it was at. And so, in this case, I really try, especially when things are going in our direction, to avoid trading or rolling for any kind of debit. In this case, it would be a debit. The other day we rolled, we got a little bit of credit. This would be more of a debit, which would mean that in the event that the stock returned to the price we bought it at and broke even, we would end up negative on the trade because we would have paid more to roll this trade than we received for the other one. So anyway, I just wanted to point that out in depth because we might do it. I mean, if we see Microsoft roll up in the neighborhood of 108 or higher today, we might kick that roll. Now the next one, Starbucks. So I've got mixed feelings about this. On the one hand, it's always terrible to see a big negative number, right? That 510 is a big. It weighs down heavily on us because it's eaten up all the gains we've had so far elsewhere. But it's kind of on the other hand, it's kind of a good thing because we had a mostly bullish portfolio leading into this, and we opened this position as a hedge against the market dropping. So while this looks bad here, in the event the market dropped this week, as it very well could have, this would have been a great return that would have hopefully offset like losses in Carnival and losses in uh, Microsoft as well. So in this case, yeah, we'll take a little bit of a hit for the fact that that happened. And the position we're in now, which is kind of unenviable, is that the maximum loss we have for this trade, that 17 contracts against a 50-cent spread, means that we could lose 800. We would be on the hook for $850. Now we received 425, which is half, which means the most we can lose is 425. But as you'll notice here, this number is obviously well above 425. And the reason for that is because it's using the market pricing, and therefore the liquidity cost to just close this with a market order right now would be more than our total loss. So ideally what we'd want is we'd want to be able to exit out of this position, and we have an order already standing. We had hoped that maybe we could close out at that 25. We're going to see if we can close out, and I'll move this down, right? You can see the net debit is 51 cents. That's the midpoint, which is still uh, worse, frankly, than the 50 cents that it would be intrinsically. Let's walk this in. I mean, I'm going to just see if anybody's willing to take anything off our plate for 49 cents. Or maybe let's see if we can't go a little bit lower than that. Let's say we'll just say we'll go down to 47 cents. And I don't really expect anyone to come in, but sometimes what will happen is people will start to nibble away at the order, which means that you'll see partial fills where, for some reason, and you never really know what's going on elsewhere. For some reason, somebody will come back in and they'll buy one or two of these, or they'll sell us back a few of these because you have people on the other side, and the people on the other side of this trade who might be retail investors like we're being right now. They may have gone into this position and the same time we did. Maybe they ended up on the other side of our trade, and now they want to close it for their profit, and they recognize that they're not going to get the full amount of the spread for it, and they're going to have to pay a liquidity cost. If they just go and offer at the net debit, or rather their net credit, which in this case would be like 47, then that would fill for us, and we'd start to do it. So we'll let it hang there. Actually, I'm not going to be greedy. See if we can just close it out for anything better than the full loss on the trade. We'll let it hang this for a little bit. We're also going to go off to take a look at the portfolio once again. And we've got, yeah, those were the positions we cared about. The only last thing here is this Johnson and Johnson trade. So we'll go back to our orders. We'll see that this is still sitting out there. 493. We'll change it. We'll see if we can get. We'll see if we can get that midpoint to fill. In this case, 492. That's fine. We'll let this hang a little bit because we also want to go off. And there's a few trades I wanted to look at. The main thing is we have Carnival Cruise. This order closed. Let's go see how Carnival's looking today. We can see it had a pretty strong start and then sort of has kind of relaxed down a little bit today. I do want to get back into this. We were looking at, I believe we were using the Februaries before, and I think I want to get back into the February trades. So what we're going to do is we're going to give ourselves a budget here of, let's say we'll go for 500 again against the market pricing. And unfortunately, it looks like we're getting a little bit crowded on the trading here because this is not a great potential return for that. You'll notice too, we still have some settings from before. So some of the main settings are the minimum return of 0, meaning that for the view that we're looking at here, which is this bullish view of a 0 volatility movement upwards up into a +1 volatility movement, all based on the implied volatility. That we don't want to see any trades for our view, our slightly bullish view, where we lose money. And so that's just simply saying that this trade's going to be profitable at expiration if the stock doesn't drop from where it is today. And that's one of the benefits of the tools. We can optimize for stuff like that. And we've also said to exclude range bound trades because there's always going to be super precise trades like condors and butterflies and so on where you can get massive returns they'll offer. But the problem is that you have to kind of, you have to be really precise. In this case, you can see it's range bound. So like if it drops below here, it's going to start to lose money. And if it drops below here, if we go dig into it, you can see like you'll lose money on the outside. So don't get confused just by this beautiful return for your view because you might be wrong, which is going to happen on occasion. So we'll exclude those range bound trades and we'll be positive. And, we'll go for the bull put spread. This is another credit spread. And I'm going to send it to the trade ticket, not worry too much about it. And we'll see if we can shave in. I know that Carnival's not super liquid on the options. So we'll just place this order, see if we can get $1 for it. And now getting $1 for it is because it's a $2.50 spread, if we collect that dollar, we're trying to get 40% of the spread. And that's, ideally you'd want to get half because if you got half on what might be considered a 50-50 trade, then that would be a sort of a break even. But keep in mind that in the event that they were to give you that dollar or that they give you that 50% of your spread, what that's really saying here is that they think it's a fair trade to get on the other side of. And we had talked about this a little bit yesterday with Tilray to say that the fact that it was really hard to make money on the stock falling, but it was really easy to make the money on the stock rising, that clearly the market had come to the conclusion, and we'll go take a look at how Tilray is doing today, the market had come to the conclusion that this stock was on its way down. And we shouldn't really be surprised that it did tank. Now, I didn't think it was going to be this fast, but we didn't open a trade yesterday because we couldn't see anything that was really worth it. Because if you recall, the forward price on the stock, it looks like this water slide, and it's just you have to not only be right about the direction, you have to be right about the velocity, how quickly it's going to get down there. Had we known we were going to see a 7% drop today, we could have absolutely found a way to make money on that. But all we really saw was a big drop over the long run. And according to this, looking out, let's go to the 90-day, so 3 months out, it's being priced just for a $4 drop from here. So the question is, do we get in on that or not? And I say no because we've got this earnings here. However, coming back to the portfolio, we'll take a look at, we still haven't filled Johnson & Johnson or Starbucks. Let me see. I would like to get that Carnival trade to fill. Again, it's kind of floating around this 93, 95 point. The other trade that I wanted to do is I actually wanted to offset our Carnival trade with a bearish trade on Vale. Now, Vale is a company that is just not in great shape right now. It's really just on its way down. And there's kind of a few ways to look at this. I mean, on the one hand, looking at the let's go to the 1 month view. They disappointed on earnings, and so they've kind of dropped, and they've dropped down and they've continued to decline, and there's just not a lot positive going for them in terms of the analyst views. Although we do see a kind of a good upside today. They have moved up, but again, they're moving up with the market, so it's tough to say exactly what's going on there, whether it's short covering or who knows what. But I guess the thing we want to think about here with trading this stock is if we were to get in a bearish trade for Vale, the purpose of that trade would be to offset and to hedge against the bullish trade on Carnival. So we would go with the same mindset of, in this case, saying, hey, we're going to go 28 days out and we're going to look for a bearish trade. And as we would come down in this direction, we would see that, again, there's not a lot of money to be made here because well, first of all, the liquidity is not great, but second of all, the market is expecting them to continue to go down. At least the options market is still bearish on them, and that's why there isn't a ton of opportunity here. But if we go with the trade that's being suggested, this is the best we can get for the current pricing we're looking at. We're going to go to the trade ticket, and again, I'm going to send this right in and see if we can get a slightly better deal for it. So you can see the spread is just huge. Now this is a $5 spread for the $5 strike spread, and if we can get $2 to close that, again, that's looking at another 40%. Not a again, not a great fill, but if we can fill it, we'd be pretty happy to get a little bit of cash on there. And the part of the purpose of this trade is to help offset the loss. So ideally what happens for our expectations is that Carnival continues to go up and Vale continues to go down. If those do continue to diverge in the direction that the market kind of indicates they will, and the views that we have, then we can hopefully profit on both of those. But in the event that there is a big movement in the market or there's a big movement in that sector, then we're going to get wiped out on one of the trades, but the other trade will offset a significant portion of that loss. And that's sort of the point of hedging those two guys against each other. Now we get to the fun and exciting part, which is we just walk through and try to close the orders we've got on the day, because we do want to get out of a lot of these positions, or we want to fill these trades, I should say. So I'm just going to walk through trade by trade and spend a little time trying to carve in to see if we can get to close the order. It's not a big deal for us to take, for example, the Starbucks loss and to close it at the current value, but there's no point in really going over, because it's going to cost us, in this case, for every cent we go over on the trade, it's going to be $17, and the assignment fee is I think it's $10 to $15 or so. So once we get past the first 2 cents, it's just worth it to just let the whole thing get assigned, and I'll talk about that in a second. Let's see if we can roll this guy in a little bit. The net credit's down to 90. Well, we'll see if we can take it. Not a ton of volatility. As we can see, the volatility is starting to drop down. We got that filled at mid, which is nice. We'll come in here, see if we can't get this guy filled. So we'll let Vale sit there for a sec. And then I had talked about Starbucks. One of the questions that came up was exiting spreads. And this is a situation where what happens if we get to the point where we are at expiration and we're holding on to positions that are in the money, and which is an important question. The answer is this: if you have a stock that's like even 1 cent in the money, or an option rather that's even 1 cent in the money that you are long, when your broker sees that after markets are closed and you get to the point of expiration, it will automatically be exercised for you unless you call them and tell them not to. This also works on the other side of the coin, which is that you'll get assigned, or you can assume you'll be assigned by someone else's broker or someone else exercising their options at the same time. Now, when you're deep in the money, as we are here, which is just $1, but it's still pretty deep at this point, we can assume that both of these will get either exercised or assigned overnight. So if let's say this was between these two, and like our long position was not in the money, we would have to worry about this call getting assigned, because it would definitely happen, and this call that we were long on wouldn't be worth it to exercise. And so we would have to go and manually close this out today for sure, because the broker would say, well, do you have 1700 times 65 on hand to go afford, or rather, you could short these, but they don't want you to short them. Uh, Especially if they're going to be uncovered shorts of that stock. So you'd be able to receive this. I mean, I guess technically, besides the margin requirements, there's no reason you wouldn't be able to get shorted all that stock. On the other hand, if you were long an option that was in the money and not short anything to offset it, you get a call from the broker saying, "Hey, you're about to pay 1700 times 65 to buy this, and you don't have the cash in your account. So, what are we going to do? Are you going to close it out, or how are we going to handle it?" Now, in the event that they are both out of the money, in which case, let's say Starbucks went our way and it was down at below 60 today, and both these options had 0% likelihood, then they just expire and go away, and you don't have to worry about it, and you just move on with your life. However, we're at the other side, which is the worst case, which is that the trade went completely against us. They're both virtually guaranteed to be exercised or assigned. And the good news is they just offset. You'll probably have to pay, I think you pay both sides of the fees, because there is an assignment fee, which is the fee of you getting assigned, and then there would be an exercise fee of your options getting exercised. But the brokers understand that, by us leaving our position like this today, they're going to go execute that trade on our behalf. And the good news is, it for all intents and purposes, you can think of it as being cash settled, because they're just going to say, well, there's a 50-cent difference in this spread, therefore it's going to be 50 cents times the 17 per. So in that point, you'll lose 850, and then you'll also get hit with the assignment fee as well. So that'll tack on a little bit of extra cost, but that's kind of the important thing to know there. In general, you prefer to get out of these things. If you can get out of these for anything, like either at the total cost or even less, in this case, we don't pay commissions. So if we could close this at 50, I'd be happy to do it. But it's very difficult for anybody to come along. People aren't likely to come and pay us 50 cents for this, because that is the intrinsic value of the spread. So somebody who'd come in and pay for this, they would really just be putting themselves at risk. Now, let's go take a look at our orders again and see what we can't go and fill. We'll start with the Johnson & Johnson. 489, yikes. 488, fine. So we'll chase this down. It's kind of a bummer too, because I would have loved to close that closer to 5. Starbucks, rather, we're going to let sit. Vale, we want to close in on. It's 190. We offered 195. We'll change it to go to the midpoint. You should never assume you're going to fill at midpoint. The midpoint fill is as great as it is. In this case, we might end up walking away from this trade, because I don't want to keep chasing this down. So it's very possible with the book we have right now. Once we get Starbucks, Starbucks is going to be off our books, one way or another, by the time Monday hits. And so at that point, if we're looking at that, we don't have this negative. We're going to end up being pretty bullish, because we won't have this negative 17, but we also won't have this positive 15. So these guys are going to cancel each other out. So the net is, our current book is bearish by $8 a share. I'm okay if we don't get Vale filled. So we might just walk away and just leave the book as it is. Yeah, we might just leave the book as it is, but we definitely do want to get out of J&J. And this again, we're chasing the spread. We're gonna have to bring this guy down again. Oh, one thing to note that just happened, and I wanted to point it out. This, for example, will say net credit at 487, because we calculate the half, but this will say 486. This is often, it has to do with the way rounding works in the underlying platform we have, rather in your browser. So the midpoint here is actually 486 and a half, and it gets rounded up by the UI, but then it's actually 46 and a half, which rounds off. It truncates. So this is rounded and this is truncated. So 486, 5, that 5 gets cut off because we can't trade that. And so I'm trying to figure out why we're not able to get a better fill here. I mean, we're closing down pretty fast right now. It's definitely losing speed. I guess Johnson and Johnson must be they must be showing an end of day a little bit of drop. Yeah, let's just work to get out of this a little faster. I don't know ordinarily if this, as a personal account, I would sit around and probably wait and see what happens, or I might sell just the call, or rather just the put and let the call run for a bit. But we're gonna hustle through this and get this filled because we want to get out with whatever little profit we can eke right now. No, this isn't super exciting for streaming, and we didn't get a lot of time to get into much um, much of the financial theory stuff. And we did check in on Tilray, which was interesting because it worked. It worked really quick in the direction we thought. But for now, I'm actually surprised we haven't been able to close this out. I really thought that we gotten somebody to bite. So let's just see if we can get out before we start to lose money on the deal. My goodness. Is that 475? Oh boy, that's terrible. Yeah, it's a bummer that it came down that far. But I mean, such is life. You take what you can get. We did make a profit. We turned a slight profit on that, which I'm pretty happy about. But yeah, I don't see us getting. I'm going to let this sit and see what we can take. Frankly, it doesn't matter how much of this we fill. If we get hit with an assignment fee, it's going to be for the assignment fee is just a net thing. It's not a per contract or anything. And so on the other side of the coin, if it fills, um, we get the fill and we pay a little bit of fees. But I will try real quick just to see if we can't get this closed out at 51. Because I forget the exact price of these. But right at this point, I mean, I don't know why anybody wouldn't bother taking that. I mean, that's collected 51 cents for what would be 50 cents of risk. There's there's no real reason not to do that. But um, I'll just let that hang out for the rest. I don't think this Vale trade's going to fill for us. We're asking for a buck 90, which is even over the credit at this point. And so we'll see what happens. If it does fill, we're just going to leave it out there for the day. We'll see on Monday whether or not we were able to get a taker. Uh, we'll let this um, we'll let this hang out here as well. Again, if somebody comes in to swoop it away, I think if we keep it at 51, they'll probably close in. But I don't want to waste any more time hanging out here. The end of day portfolio is a little hard to evaluate. We are up from yesterday by a little bit, which is nice. We're still trying to get over that 26 hump though. Um, we're not going to do any hedging or extra activity today. So we're just going to kind of sit here and and just let the market continue to move up. I think that that's sort of been one of those things that worked against us this week, is we put in a pretty strong weekly bearish hedge, and then when the market did not, when the market had a pretty strong week, I mean, it just kept moving in the direction we wanted. What was it? If we get to the 1 week, this was the week we're looking at. So I mean, there's not a ton you can do if you have a bearish trade on your plate there. So anyway, I hope everyone else having better weeks out there. If you have any questions, as always, please hit us up at hello@quantcha.com or leave a comment below. And as always, good luck and good hunting.